Give me 18 minutes and I will show you how to analyze stocks like professional money managers. I've been doing this for almost a decade now. I have averaged a performance of 25% per year, and I am managing my portfolio like a professional. So I can tell you how to do the work, analyze the stocks like professionals. I've been working in the industry for some years now, and yeah, so far so good. I have analyzed hundreds, thousands of stocks in a professional way, and you have some patterns to detect if a stock is good or not, if a company is worth looking at or not. And the first point I want to make is you will have to dismiss many of your best loved ideas. Not everything is worth looking at. You will see many stocks online, on the internet, on Twitter, on YouTube. The goal here is not to look at everything. Okay? You don't have the time to look at all the stocks at a limited amount of time. You have to be very selective. You have to be a harsh grader. So you need criterias, filters to filter out the bad companies. So if you want to look at the big picture, if you are faced with a new company, something you can look at very easily, you can skim through the financials and you can detect some patterns. If you want to find quality companies, if you are a quality fund manager, you want to be invested in the company that is growing revenue. You will see that very few companies can consistently grow revenue on a yearly basis for the past 20 years. If you have cyclicality, if you have flat revenues, if you have declining revenues, that's automatically out. The way to do it, you can check on several websites, Fiscal AI, Stock Unlock, Guru Focus, check some trends. Second point, what is the growth rate of the revenue? Is the revenue growing at 3% per year? Or is the revenue growing at 20% per year? Keep that in mind, and you can continue in the income statement section by looking at the profitability. To only pick stocks that will outperform the market, you want to be invested in winning companies, so you want to be invested in companies that are growing profitably. I don't believe in turnaround plays. I don't believe a company can suddenly turn profitable and be always profitable. Most often, companies that were unprofitable suddenly become profitable. They have many execution risks, many issues in the short term, and they can become again unprofitable again, turned back to having losses again. Also, when you have a turnaround play and a company starts from being unprofitable to being profitable, that's because of a change in management intensity, and the growth rate falters. So just remove these unprofitable companies. It will be also helpful for the valuation. So first point, revenue. First point, revenue growth rate. Second point, the margin profile. If you want to pick companies that will outperform the market, you want to be invested in winning companies. So you want margins that are increasing. Depending on the industry, you have specific thresholds. For example, if you are talking about a software company, you will see gross margins that are really high, like 60, 70, 80%, net margins roughly 30%. This is a good benchmark for software companies. For retail, that's much more different. You will have gross margins of roughly 30% and EBIT margins of roughly 15%. That's a good threshold for a good benchmark for retail companies. For cyclical companies, commodities, cars, impossible, because these industries are so bad and cyclical, so bad for investors. You cannot forecast the future. Again, that's another layer of filtering out bad stocks for your portfolio. You want a good quality company filled with quality stocks that are not cyclical. So you want to be able to see the future, to forecast the growth rate. For cyclical companies like car makers, coal miners, it's almost impossible to forecast the future because you have too many variables at the same time. Okay? And professional managers understand these variables. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. A good question to ask is, if you are faced with a new business, a new stock, what are the variables that will impact your business model? How many variables do you have? Do you have only 3 things to monitor or 15 things to monitor? The level of complexity, 15 things to monitor, is not good at all. You want as few metrics to monitor, because I'm telling you, this exercise of screening new ideas, you will monitor many companies at the same time, which means you want the process to be as simple as possible. You start from the income statement, revenue, you go down the list, margin improvement, and then you go to the balance sheet. The balance sheet part is very straightforward. You want to look at the cash balance, cash and cash equivalents, and you want to look at the long-term debt. Okay? You can just compare these two ratios and see what you have. If the company has more cash than debt, so you have a company that is net cash, or the reverse, more debt than cash, so the company is net debt. If the company is net debt, you can see what is the level of net debt, the difference between debt and cash, and you can compare this with the free cash flow of the company, how much cash the company generates every year. In how many years of free cash flow can you repay your debt, your net debt? A good ratio that I like to use is 4. So I want my companies to be able to repay their net debt in 4 years maximum. Ideally, you want to be invested in companies with a net debt of 0. That's the golden era of capital allocation. Some businesses are like this. Amazon is like this. Tencent is like this. You have a lot of cash, a lot of debt. Debt is used to fuel reinvestment rate. Okay? So not all companies are like this. You need amazing capital allocators. So the safe route, if you want a safe portfolio with safe companies, is to only be invested in companies that are either net cash or net debt, but the ratio of net debt to free cash flow should be below 4. Okay? You want companies to be able to pay off their debt very easily. That exercise will force you to filter out companies with too much debt because they don't generate enough free cash flow to repay their debt below 4 years. It's a very good filter. You will see that very few companies are safe like this. So you combine the revenue growth rate, the margin improvement, and the balance sheet safety, and now you have filtered out almost everything. You have only good companies that are safe. Another thing you can check in the balance sheet is the current ratio. It's a ratio between current assets and current liabilities. You want this ratio to be above 1. And also you can monitor what is moving in the balance sheet. So what I like to do, and what I have learned to do in investment funds in Paris and also in Europe, is to see what are the big lines in the balance sheet. For assets, for example, what matters in assets in the balance sheet? The inventory, or something else, or the receivables, or the payables, or same thing. When it comes to the asset, liabilities, receivables, payables, look at the big lines. What are the big lines? The goodwill, if the goodwill is big, it means a lot of acquisitions. So you go down this rabbit hole of acquisitions. Okay, if the goodwill is big for a company, if this line is huge, you can check what is inside the goodwill. Do you have some intangibles? Why? Since when? Since an acquisition? Okay, what was the price paid for the acquisition? What was the motive for doing the acquisition? What were the synergies that were expected? And did they realize their synergies? The first question follows another question, another question, another question, another question. Okay? Same thing for inventory. If the inventory is a big line on the balance sheet, ask why. Do you need to build up your inventory because you are talking about a seasonal business? Or is it just because the company wants to play safe and you have a lot of inventory? And how has the inventory moved for the past 10 years? Is it like going up and down every couple of quarters? or for some years it's massively down. For some years they are overbuilding the inventory, like 2021, 2022, and the inventory is huge. For supply chain issues that we had in 2021, many companies overbuilt the inventory. You buy more stuff just in case because you had inflation and supply chain issues. So just in case you buy upfront, even at a higher price, but you have your stock. And then you sell your stock in 2022, 2023, 2024. See how these big lines are moving. So that was for the balance sheet. You can do this exercise for all the companies, check all the big lines. And then the other financial statement document is the cash flow statement. This is the most difficult document you can analyze. I would say look at operating cash flow, the trend, the growth rate, and you can see all the moving parts of the business. Similar exercise, you want to check what are the big lines. So for all the companies I am analyzing, I check what are the big lines, what are the things that are moving the free cash flow. If the line is minimal, something is not important, I am not spending 1 minute talking about this. I only focus on what matters for companies. I only focus on big lines, and then I ask question. Why, what has been the trend, etc., etc., etc. For cash flow statements, I would say most importantly, you want to check the operating cash flows, net income, SBC, working capital, and capex, obviously. And then we are talking about capital allocation. You can see what the company has generated for cash, so operating cash flows, and you can see the cash outflows, acquisitions, capex, repayment of debt, payment of dividends, payment of buybacks. You look at these 5 metrics and you see what is important for the company. Is most of the cash flow used to pay dividends or to pay buybacks or to have capex? What has been the trend of capex over the past decade? You have more capex compared to the revenue or less capex compared to the revenue. The exercise here is to spot trends. What is important? What is the vision of the management team? What are they focusing all their attention on? Do they focus a lot on buybacks, or they focus a lot on capex or payment of debt? What is the cost of debt? All these kind of questions. If you can sort things out when it comes to capital allocation, you can really understand how the management thinks. Which means if you know the track record of the management team, the past 10 years, 20 years of the management team, you know how they will react in the future. And this is the kind of exercise I do for all my companies that I have in my portfolio, but also on my watch list. I know how the management reacted for the past 20 years, so I know how they will react in the future. If they will take advantage of the volatility in the market, if they will increase the buyback program in the future, if the stock price drops, these kind of things. By the way, talking about the debt and the repayment of the debt, you can know this information by looking at the maturities of the debt and when do they have to repay the debt. For some companies, they have to pay their debt next year. You know that some of the cash flow will be used to repay the debt. For some other companies, they have to repay their debt in 20 years. Like Berkshire Hathaway issuing debt in yen from Japan for 2042. These kind of things. So very low interest and in yen currency, and you have to repay your debt in 20 years. You want the maturity to be as long term as possible, and you want the interest rate on the debt to be as low as possible. This is the best case scenario, and you can understand how the management thinks about the debt. Okay, so we have covered income statement. What are the things that are important? The balance sheet and the debt. We have covered the cash flow statement. Now I want to talk about incentives. Very few people, retail investors, talk about incentives, but that's very, very important. What I want to know is how is management paid? First, do they own a lot of stocks? Do you have big insider ownership for your companies? I can give you an example. Mark Zuckerberg from Facebook, he owns more than 10% of the company. That's his baby. He is very much incentivized to push the stock price up in the long term. Another company I can give you is Fortinet in the cybersecurity industry. The two founders own 15% of the company. They want the company, the stock price, to go up in the long term. Okay? So the first thing is this. You want to see if the management team owns a lot of shares. That's a green flag if they own a lot of shares. The second thing that we spend a lot of time talking about when I was working in an investment fund was what were the incentives, the variables to get a bonus at the end of the year. If you are a CEO of a company, what are the variables to have a fat bonus at the end of the year? The variable part of your salary. You have a fixed salary and a variable salary, depending on what? The revenue, the adjusted revenue, the margins, the adjusted margins, the capex, the improvement, the ROIC, the buyback, the earnings per share, all these things. Guess what? You have all these documents that are available on the internet. And very few videos on YouTube or people on Twitter are talking about the power of incentives. You can see how the management will think in the future if you know how the management is incentivized. If the management is incentivized to grow revenue, there is a high chance they will make stupid decisions, like a massive acquisition to double your amount of revenue, to double your salary, and buy a new house, a new boat. If the incentives of the management team is about revenue, they can do stupid things. Now you can take the other side of the coin. If the incentive of the management, if the core incentive, the variable part of their salary is based on free cash flow per share, this is maybe the best kind of incentive you want. Or return on invested capital, the ROIC, very good incentive. It's about efficiency. You want companies to grow with a lot of efficiency. You want to shy away from companies that grow at all costs with stupid acquisitions. These are the kind of exercises I like to do for my companies. So we talked about qualitative measures, qualitative measures, and then how to judge the management team. And the last point I want to make is about valuation. I've learned from my past experiences that when it comes to valuation, the more simple, the better. All the complex valuation tools are worthless, useless, because it's just too hard and too wrong. Some people like to forecast many things at the same time. What will be the margins of each segment of the business model? What will be the tax rate of the business? What will be the capex of the business? All these growth rates that people put on a DCF and they try to forecast this for the next 5 years. It's a waste of your time. I've done it in the past, and I know for good certainty that it is useless because it's already hard to forecast two things like the free cash flow growth rate or the revenue growth rate and the margin profile. It's already hard enough to forecast two things, and some people have the ego of forecasting 30 things at the same time. Maybe this is you. Maybe you know people that are doing this. I have a success rate that is much higher when I go to a more simple valuation framework. Go for simplicity. Only forecast a few variables. Forecast the free cash flow in the next 1, 2, 3, 4, 5 years. Think in terms of multiples. A simple DCF model would do the work. The large part of the research has to do with the business. And at the end, you talk about valuation. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.